Today is April 10, 2026, and a significant shift is brewing for Australian property investors. The federal government has confirmed that its Treasury Department is actively modelling substantial changes to property taxation. These potential reforms are slated for consideration in the upcoming May 2026 federal budget. They target negative gearing the capital gains tax discount. This is not just theoretical chatter, it represents a concrete move toward a major shakeup. The timing adds another layer of complexity for investors who are already navigating a challenging economic environment. The Reserve Bank of Australia has already increased interest rates twice this year, pushing the cash rate back up to 4.10%. That has put a significant squeeze on mortgage holders, particularly those with investment loans. Together, higher holding costs and reduced tax benefits create a perfect storm for property investors. This makes it imperative to pay close attention to discussions out of Canberra. Treasurer Jim Chalmers has said tax reform is on the agenda for the May 12 budget, though details remain under wraps. The modelling's consistent focus on those two pillars signals a clear direction of intent. For decades, these incentives have underpinned nest egg strategies across Australia. The key takeaway is the status quo is under serious review. No law has passed yet, but the window to prepare is now. So, what exactly is the Treasury looking at? The proposed changes center on two key mechanisms. First, a potential cap on negative gearing. Model, limit deductions against non-property income, such as your salary, limited to a maximum of 2 investment properties. Losses on a third property would be quarantined. Losses on a fourth would also be quarantined. Subsequent loss-making properties? Quarantined. Quarantined losses could only offset future rental profits or a capital gain from that specific property, not your wage income, shrinking the immediate tax benefit. Second, cutting the capital gains tax discount. Currently, long-held assets are taxed on only 50% of the profit. The government is modelling a lower discount, 33% or even 30%. Example, 200,000 profit. Currently, 100,000 is added to taxable income. Under a lower discount, you might add 134,000 instead, increasing the tax due on sale. To soften this, grandfathering provisions are widely expected. Properties bought before a cutoff could stay under old rules for life. Example cutoff, July 1, 2026. That spurs urgency to buy before the deadline, but could trigger a 61% investor pullback signal. At first glance, the proposed 2-property cap seems targeted. Over 90% of investors own 1 or 2 properties. About 9.5% own 3 or more, the cohort in the crosshairs. For them, quarantining losses could upend highly geared low-yield strategies. But a CGT discount cut is far more widespread. It hits anyone selling for a profit, regardless of portfolio size. From first-time landlords to seasoned professionals, lower discounts lift the tax bill and trim after-tax returns. That could make property less attractive versus other assets for pure growth. The long-favored small loss for growth strategy loses shine as deductions shrink and exit taxes rise. Expect a pivot toward properties that pay for themselves from day one, often in regional hubs or specific urban corridors, and into different dwelling types. Renters could feel secondary effects if supply tightens. If investors step back or sell, rental stock may shrink, pushing rents higher and straining affordability when budgets are already tight. With significant changes on the horizon, proactive investors should fortify their position. So listen up. Panic is never a strategy, but informed action is. Here are 5 practical moves to consider before the May budget. 1. If you are buying a sound asset, consider accelerating settlement to secure current rules under likely grandfathering. It can deliver a lasting advantage. 2. Pivot toward positive cash flow and reassess strategy. If loss deductions are capped, loss-making assets are less appealing. Seek higher gross yields in strong regional centers or high-demand corridors. A property that pays for itself supports a more balanced approach. 3. Consider commercial assets, office, retail, or industrial, often with longer leases and higher yields. 4. Explore purchasing via a self-managed super fund, super income taxed at around 15% with potential 0 CGT in pension phase. 5. Maximize the 6-year main residence rule if you've moved out. Keep records to substantiate main residence status. Do not panic, but do not be complacent. Educate, analyze, and model scenarios with your advisors. Begin preparations now to find opportunity within the shakeup.